Hey guys, Rebecca here from Empowered Finance, and this is part 2 of my 3-part series aimed specifically at self-employed people. So the next couple of things I wanted to talk about in this particular video was how do lenders calculate your income. So most lenders believe that by looking at your past tax returns, they can predict how stable your business will be in the future. Banks and non-bank lenders alike tend to be very wary if you have an income that has increased or decreased by a large amount in the last 2 years. So one lender may use the lowest of the income figures for the last 2 years. Another may use the most recent year's income as shown on your tax return. Another one or other ones average the 2 years' income or take 120% of the lowest year's income. They may or may not then add back expenses shown on your returns. And some lenders accept your 6 months pay slips and a letter from your accountant instead of providing tax returns and financials. So as you can imagine, this makes a big difference to your loan application. Importantly, every lender will interpret your tax returns in a different way and may look at your skills as an entrepreneur, your experience in the industry, and the risk profile of your industry to determine how to assess your income. So depending on your situation, we may pick and choose which information to provide to help prove the highest possible income. If you can provide them, then we may ask for business activity statements, an Australian Taxation Office tax portal printout, or bank account statements for the last 3 to 6 months showing your turnover. The next thing I wanted to quickly talk about is, what if you make your own income? So under a new policy from one of our lenders, you may qualify for a loan based on the following. You require 2 pay slips or 3 months salary credits plus an accountant's letter as a substitute. All self-salaried income is treated as PAYG, therefore it will be taxed as PAYG as well. And business should be operating over 2 years and salary paid for at least 3 months. And you don't require any notice of assessments, tax returns, or financials. What do lenders think? So this will be the last thing that I'll cover off in this video. What do lenders think? So lenders have the view that self-employed borrowers represent a higher risk because their income isn't as stable. Some banks even view these in the construction industry less favourably than those from accounting firms, especially at the moment. This is simply because banks have seen higher levels of default over the years from particular industries, so tend to be more conservative when lending to them. At one time, a leading mortgage insurer even refused to approve low doc loans for builders. As you can see, the banks complete a more thorough assessment of applications from business owners. Now, unlike most major banks, we know that there are also hundreds of thousands of businesses Australia-wide that have been trading profitably for years. It just isn't fair to paint them all with the same brush. So we know which lenders treat self-employed people more favourably, and we'd love to be able to help you through this process. As I said, I'll leave it. I might just add one more thing, just one more thing. So how will lenders view my tax returns? So when a credit officer working for a bank receives your tax returns on their desk, they'll check to make sure that you've signed and certified and backed up by notices of assessments. This is a simple fraud check just to make sure that these are the tax returns you lodged with the Australian Taxation Office, also known as the ATO. Next, they'll usually look at the last 2 years' taxable income and add back any unusual expenses, such as one-off losses. Did you know that some lenders will add back extra super contributions and even depreciation? This is where the banks really show a large difference in the way they read your tax returns. Banks will also have different documentation requirements depending on if you're a company, a trust, a partnership, or a sole trader. They may ask for interim financials or cash flow projections, depending on the nature of your business and the risk of your application. So I hope that information has been helpful, and I'll leave it there for today. Keep an eye out for the last video in the series. And again, reach out, let's have a conversation and talk about how your how I can help you with your particular circumstances. Have a great day.